Kia ora, I'm David, and welcome back to New Zealand Pension Plan, the channel where we cut through the confusion and give you straight verified answers about NZ Super, WINZ payments, and everything affecting your retirement income. If you're currently getting NZ Super, listen carefully, because there are 5 specific situations where work and income can reduce your payment, and most people only find out after it's already happened. This isn't scare talk, and this isn't some social media rumor I picked up somewhere. Every single point in this video has been checked directly against Work and Income's own official pages. No guessing, no assumptions. By the end of this video, you'll know exactly what to check so it doesn't happen to you. And you'll understand exactly why these rules exist in the first place. Before we get into the 5 reasons, I want to say something important, because I think it will actually put your mind at ease. Work and income does not cut your pension randomly. It's not a punishment, it's not a mood, it's not some hidden agenda. Every single reduction in your NZ Super traces back to one of a small number of very specific, very documented triggers. That's actually good news because it means this is something you can control. If you understand these triggers, you can protect your payment and you'll never be caught off guard. So let's slow down and go through each one properly with real examples so you know exactly what to look out for. Let's start with some background, because I think this will help everything else make sense. NZ Super is what's called a universal pension. That means it's not tested on your income and it's not tested on your assets. Whether you've got a mortgage-free home worth $1 million or you're renting a small flat, your eligibility for NZ Super itself doesn't change because of that. This is different from a lot of other government payments, which do look at your income and savings. So when people hear the word cut, they often assume it's some kind of means test kicking in. It's not. The reductions we're talking about today come from a completely different set of rules, and once you see them laid out, they'll make a lot more sense. Right now, as of the current rates that started on the 1st of April this year, if you're single and living alone, your fortnightly NZ Super payment after tax is $1,110.30. If you're single but sharing your home with other adults, say an adult child or a flatmate, your fortnightly rate after tax is $1,024.90. And if you're in a couple where both of you qualify for NZ Super, you each get $854.08, which combined comes to $1,708.16 as a couple. These numbers matter because the first reason your payment can change is directly tied to which of these categories you fall into. So, reason number 1, your living situation changes and you don't tell work and income. Think about how much your household can shift over a year or two. Maybe your adult son or daughter moves back home for a while. Maybe you start a new relationship and move in with your partner. Maybe a flatmate who was helping with the bills moves out, and you're now genuinely living alone again. Every one of these situations can change which rate tier you fall into. Living alone is the highest rate because work and income recognizes you're carrying the full cost of a household by yourself. Sharing brings the rate down a little because your costs are shared with others in the home. And moving into a relationship changes things again because now you're assessed as a couple. Here's where it gets risky for people. If your situation changes and you don't update work and income, you'll likely keep being paid at your old rate. That might feel like a lucky break at first, but it isn't. It creates what's called an overpayment, and overpayments always eventually get noticed. Sometimes through a routine review, sometimes when your file gets flagged for another reason. And when that happens, you don't just go back to the correct rate. You're asked to repay the difference, sometimes going back months. I've heard from viewers who didn't realize their flatmate moving out technically changed their rate category, and they ended up with an unexpected letter asking for repayment of several $100s. It's completely avoidable. If anything about who you live with has changed in the last few months, the simple fix is to log into My MSD or give work and income a call and update your details. It takes a few minutes and it protects you from a much bigger headache down the track. Now let's move to reason number 2, which is one of the biggest ones I get asked about, especially from people who've spent part of their working life overseas. An overseas pension you haven't declared. If you've ever worked in the United Kingdom, Australia, the Netherlands, or a number of other countries with their own government pension schemes, there's a good chance you're entitled to some kind of pension from that country as well as your NZ Super. Now, here's the rule, and it surprises a lot of people the first time they hear it. Work and income doesn't just let you collect both in full. Under what's called the direct deduction policy, if you're entitled to an overseas government pension that's similar in nature to NZ Super, the value of that overseas pension is deducted from your NZ Super, dollar for dollar, up to the value of what you'd normally receive. Let me give you a simple example to make this concrete. Say someone is getting the standard NZ Super rate for a single person living alone, and they're also entitled to an Australian pension worth a certain amount each week once it's converted into New Zealand dollars. Work and income will take that converted amount and subtract it from their NZ Super payment. If the overseas pension happens to be worth more than the NZ Super entitlement, they'll simply receive the overseas pension instead and nothing extra from NZ Super. The idea behind this rule is that the total amount you receive should end up roughly the same as someone who spent their entire working life in New Zealand. It's not designed to punish you for having lived overseas. It's designed to create a level playing field. Now, here's something that trips a lot of people up, and it's actually one of the most misunderstood parts of the whole system. Some viewers assume that because this deduction exists, the smart move is to simply not apply for the overseas pension or to delay applying for it. That is not a loophole. Work and income specifically requires you to take what they call all reasonable steps to obtain any overseas pension you're entitled to, and deferring it doesn't get you out of the deduction. If you're found to be entitled to an overseas pension you haven't declared or haven't applied for, that becomes an overpayment situation, and you can be asked to repay the difference, sometimes with penalties attached. But I want to leave you with some good news here too, because most content online misses this completely. There's actually an option where, if you pay your entire overseas pension over to work and income, you receive the full undeducted NZ Super rate in return, and your overseas pension becomes exempt from further tax. It's a legitimate arrangement that some pensioners use to simplify things. If this applies to you, it's worth raising directly with Work and Income's International Services team to see if it's the right fit for your situation. So the action point here is simple. If you've ever worked overseas in a country with its own pension scheme, you need to declare that entitlement when you apply for NZ Super. And if your circumstances change later, for example, if you become eligible for a new overseas pension you weren't entitled to before you need to update Work and Income straight away. Let's move to reason number 3, which causes a lot of confusion because people mix it up with an income test that doesn't actually exist. Other income pushing you onto a different tax code. I want to be really clear about this because it's important. NZ Super is not income tested. If you decide to work part-time in retirement, or you've got rental income coming in from an investment property, or you're drawing down some savings, none of that reduces how much NZ Super you're entitled to. Your entitlement stays exactly the same. So if that's true, why do so many people feel like their payment has been cut when they start earning other income? The answer is tax, not entitlement. When you apply for NZ Super, you're assigned a tax code, and for most people with no other income, that's the M code. But if you start earning other income and that income becomes significant, especially if it becomes your main source of income, your tax code can shift to something like S, SH, or ST. Those codes apply a higher rate of tax to your NZ Super payment, which means more comes out before it lands in your account. Your gross entitlement hasn't changed one bit, but what you actually see arrive in your bank account looks smaller, and it's completely understandable why that feels exactly like a cut, even though technically it isn't. Here's a practical example. Imagine a retired teacher who's getting NZ Super while living with their partner, and they pick up 2 days a week as a reliever teacher at their old school. That teaching income becomes their main income source for tax purposes, so their NZ Super tax code shifts. Instead of the payment they were used to seeing, it comes out noticeably lower. Not because Work and Income decided to reduce their entitlement, but because more tax is now being withheld at source. If nobody explains this ahead of time, it can feel alarming, even though it's a completely normal and expected part of the tax system. The action point here is to check in with either Work and Income or Inland Revenue As soon as your income situation changes, so you're on the correct tax code from the start, rather than discovering a big shift after the fact. It also helps to simply expect this ahead of time. If you know you're about to start some part-time work, you won't be caught off guard when your net payment adjusts. Now, reason number 4, traveling or moving overseas without telling work and income properly. A lot of retirees dream about spending extended time overseas, visiting family, doing an extended trip, maybe even living part of the year in another country. And that's completely fine. NZ Super doesn't lock you to New Zealand forever. But your payments while overseas are subject to specific rules, and those rules depend on things like how long you're away, where you're going, and whether that country has a social security agreement with New Zealand. I want to be honest with you here rather than guess at specifics because this is exactly the kind of detail where getting it wrong could genuinely cost you money. The precise time limits and conditions are laid out on Work and Income's official page about living overseas while getting NZ Super or Veterans Pension. And because these details can vary depending on your personal circumstances and destination, I always recommend checking that page directly or calling Work and Income's Senior Services line before you book anything. I'll put the link in the description so you can look up exactly how it applies to you. What I can tell you clearly is this. The mistake that catches people out isn't traveling itself. It's not telling Work and Income before they go. If you head overseas for an extended period without notifying them and completing the right paperwork, you risk your payment being affected in ways you didn't expect or facing questions when you get back. The fix is simple and completely free. Before booking any trip that's longer than just a couple of weeks, contact Work and Income first, tell them your dates, and confirm exactly how your payment will be handled while you're away. Now let's get to reason number 5, and this is the one with the most serious consequences. Because it's really the umbrella that the other 4 sit under. Not meeting your notification obligations. Work and Income puts a lot of trust in pensioners to self-report changes in their life. That includes your living situation, your income, any overseas pension you become entitled to, your relationship status, and if you're in one of the older grandparented arrangements where a non-qualified partner is included in your payment, changes in their circumstances too. If you don't report these changes, here's exactly what can happen, according to Work and Income's own published obligations. Your payment can be reviewed and, if necessary, stopped altogether while that review happens. You may be asked to repay the entire amount you were overpaid, sometimes going back a significant period of time. On top of that, a penalty of up to 3 times the value of the overpayment can be added, which turns a manageable situation into a genuinely serious one. And in more serious cases, particularly where non-disclosure looks deliberate, prosecution is possible, which can mean fines or even imprisonment. I don't say this to scare you, I say it because the flip side is completely within your control. Nobody at Work and Income wants to catch you out. The system relies on early, honest reporting, and if you report a change as soon as it happens, you avoid every single one of these consequences. The people who get into trouble are almost always the ones who didn't report a change, not the ones who did. Before we wrap up, I want to quickly clear up a couple of myths I see repeated constantly in comments and on social media because I think it'll save some of you unnecessary worry. First myth. Some people believe that having a large KiwiSaver balance or making a big KiwiSaver withdrawal will reduce their NZ Super. This is false. NZ Super has no asset test, and your KiwiSaver balance itself has zero effect on your entitlement. The only thing to be aware of is that if a withdrawal counts as taxable income in a particular year, it could shift your tax code the same way other income can, which we already covered. But that's a tax effect, not an asset test, and it's not related to your KiwiSaver savings directly. Second myth. A lot of people have heard about the new residency rule, where the number of years you need to have lived in New Zealand is gradually increasing from 10 years toward 20 years by 2042, and they panic thinking this will affect their current pension. It won't. This rule only applies to new applicants turning 65 from the 1st of July 2024 onwards, based on their date of birth. If you're already receiving NZA Super or you turned 65 before that date, this change simply doesn't touch you. Third myth, and this one connects back to reason 2. Some people believe if you have an overseas pension, work and income takes all of it. That's not quite right either. They deduct the value of your overseas pension from your NZ Super, but only up to the value of your NZ Super entitlement. If your overseas pension happens to be worth more than that, you keep the extra amount. You're never left worse off simply because your overseas pension happened to be generous. So, let's bring this all together with a simple checklist you can run through right now while you're watching. Ask yourself these 5 questions. Has my living situation changed recently? Am I now living alone, sharing, or with a partner? And does work and income know about it? Do I have any entitlement to an overseas pension that I haven't declared? Has other income changed my tax code, and do I understand why my net payment might look different because of it? Am I planning to travel or move overseas, and have I checked the current rules before booking anything? And finally, has anything else changed in my life recently? My address, my relationship, my income, that I haven't yet reported? If you can answer all 5 of those honestly and confidently, your payment is on solid ground, and there's genuinely nothing to worry about. One last practical tip before we finish. A lot of pensioners assume that if work and income hasn't contacted them, everything must be fine. I want to gently push back on that idea. The responsibility to report changes sits with you, not with them to guess. Work and income isn't watching your life day to day. They rely on you telling them when something changes. So, if you take one thing away from this video, let it be this. When in doubt, report it. A quick phone call or a few minutes on My MSD is always going to be easier than untangling an overpayment months down the track. So, to bring it all together, the 5 real reasons your NZ Super can be reduced are an unreported change in your living situation, an undeclared overseas pension, a tax code shift from other income, unreported overseas travel, and simply not meeting your notification obligations. None of these are random, none of these are punishments, and every single one of them is something you can check today and keep on top of going forward. That's it for today's video. I'm David, and this has been New Zealand Pension Plan, your trusted source for clear, honest, and accurate NZ Super information. If this video helped you understand your payments a little better, give it a like, subscribe for more videos like this every week, and drop a comment below if you have a question. I read every single one, and your question might just become the topic of a future video. Take care, look after yourselves, and I'll see you in the next video.